Hey everybody, I'm getting a lot of questions about what do we do with our bonds, and I want to have a real conversation about this and just kind of look at it from more of a logical standpoint. If we don't understand bonds at this point, we may never understand bonds. So let's start with history. 1981, we got a peak in interest rates. When President Carter left office, interest rates on the 10-year Treasury were at 12%. Bond funds, bonds themselves had lost a third of their value from when he started. Okay, so we're talking about 33%, a third of their value. They've been cut down in 4 years because of this drastic rise in interest rates. So one thing we learn is as interest rates rise, we lose value in these bond investments. Well, why did we rise interest rates? What was going on back in the 70s and the first part of the 80s? Well, it was inflation. And the economics of that says we got to push interest rates up, whether that's right or wrong. That's what we do. We raise interest rates to help combat inflation. Arguments can ensue. I'm okay with the arguments of whether that's right or wrong, but it is what we do economically and what we have done economically. So fast forward to our latest bout of inflation. Notice that from the early 80s to about a year or two ago, inflation was really benign. It was 2-3% on average. It was ridiculous. We didn't see inflation. So we had interest rates continuing down and down and down and down and down until we ultimately hit virtually zero at the pandemic. Okay, we've been floundering around extremely low interest rates since 9/11 happened. Greenspan slammed interest rates down when 9/11 happened. Then we started rising them right before 2008's crash, and we slammed them back down. Then we started rising them right before right at the end of 2018, markets crashed. We slammed them back down at the first of 2019. We tried to start raising rates, pandemic hits, we slam them even further down to zero. That was what we did. You look at what has happened since then. We started seeing inflation. So what do? We rise interest rates. And as we rose those interest rates, all of the bond funds and bonds out there lost value. It was very predictable. Even if we didn't see inflation, we were at zero interest rates. The only direction bond values could go is stagnant sideways, or they were going to lose value. And so 2021, we lost 1% or so in most of the bond funds out there. 2022 was a disaster. They all lost over 10%. And then so far this year, as of November 3rd, anyways, we were pretty flat to down on the bond funds as well. And then as you search through all the bond mutual funds, the statistics are telling me that 99% of bond mutual funds are down. Look, we have to understand the relationship of bonds to our investing portfolio. Okay, as interest rates rise, the value of bonds go down. Here's where we are now. Okay, let me see if I can do this right. Right here. We're right here. Look, in the grand scheme of things, we're still very low. And we've had 20 years of almost zero interest rates, 2, 3, 4% at most in the last 2 decades. So all these bond funds are filled with low interest rate investments. They can't just hit sell after the interest rates rose because that value of that portfolio has plummeted. So they can't just go out and buy all those. That's why all these bond funds still yield 2-3% right now. You can't just wake up and change it because the interest rates have changed. They have bonds that have 10, 15, 20 years till maturity in that portfolio. If you hit sell, you lock in that loss. So the bond portfolios are in trouble, right? Well, we have to admit, in the United States, if we see inflation, right or wrong, they're going to raise interest rates. And we're going to lose money. And if you're retired, that is the biggest no-no you should ever expose yourself to. We don't want to lose money in inflation. What if we see stagflation? We see inflation and we see lowering stock market like we saw in the last year, right? We don't like this. Everybody looked at their portfolios and hated everything about them. Their bonds went down 10+%. Their stocks went down 10+%. Nobody likes that, right? So we have to understand the relationship from bonds to stocks because there is none. Stocks and bonds are not correlated in any way. They don't have an inverse relationship. They don't have any relationship. Bonds are correlated to interest rates and economics. They are not correlated to your stocks. We've used them as a stabilizer in your portfolio in history because history starts way back in 1981 when interest rates were way into the double-digit range, and they had consistently worked their way down since then, and bonds were great. They were great because as interest rates go down, the value of bonds goes up. And we got to earn interest. And when we bought a bond mutual fund, it was filled with bonds from the previous years. And in this case, that was higher interest rates. But we're in a different world now, right? 20 years of 3% or less type interest rates filling these bond portfolios as the good bonds they had matured. So we have to understand that when bonds are losing money, it's because we're raising interest rates. If interest rates come back down, great, that's fine. But if they don't really have that far to come back down, right? Oh, I'm going to wait till they come. Well, they could keep going back up because, again, we are still extremely low in interest rates, right? Right here. We're still very low. Now, can our economics handle higher interest rates? I think arguably no, I don't think we can. But that doesn't mean that they're not going to keep pushing it. Paul Volcker pulled the Saturday night special and raised interest rates like 3% back in the late 70s. He ripped the Band-Aid off, break things. Who cares? That's how we're going to combat the inflation. And well, they got it under control, and they were able to control it for 3 to 4 decades after that. But notice inflation came in bouts and fits. It came and it went, and it came and it went. We don't know that we're done with inflation. I certainly hope we are. I think inflation was influenced more by the pandemic. But those are more beliefs. It's not a predictable system. In economics, you can talk to every economics professor out there, and there's going to be some common themes, but they're all going to have some different ideas about how things could roll out. It's not an exact science. So with interest rates this low, we have to understand that bond funds and bonds, we got to be careful with these things. These can't be our only safe investment. And that's why the world has shifted so much in the safe investing world. So when we look at what do? Answer the question, Scott, answer the question. Well, look, especially if you're heading off into retirement or you're in retirement, if you're anywhere near retirement, in it or around it, well, we need to start pivoting. If you haven't learned your lesson, you've got to. You can't keep doing the same thing. It's the definition of insanity. We have to understand that bonds are not going to perform the way they have in the past. It's impossible. Okay, we have to be careful about this. So if your sole source of safe investments is cash and bonds in your portfolio, you've got to really rethink that. You might feel good about your cash right now sitting in a money market fund or a high yield bank account because you're getting paid 4 or 5% interest. But the second interest rates come crashing back down, then what are you going to get paid? How did that strategy work out for you? We need more reliable, safe investments out there. So take the opportunity, make it a New Year's resolution, make it something. Review your portfolio, come up with some alternatives. If you don't want to cash all the bonds out and completely change directions, start trying more of the safe investment options that are out there and start diversifying those safe investments in your portfolio. So bond funds going forward, look, even if you are adamant that interest rates are going to drop in the future, they're still filled with old bonds from the 3% years. You're completely underperforming the world out there. Risk-free, you can make 6% out there right now. Show me a bond fund making 6%, and I'll show you a bond fund filled with junk bonds and a high level of risk. There's no comparison. Owning a bond fund right now seems ridiculous to me. You want to make it part of your speculative portfolio because you think interest rates are going to dip down to zero again and you're going to profit from that in your bond fund. That's great, but that's speculative investing. That's not the stable part of your portfolio that you're relying on for stability. Okay. Then we look at individual bonds going forward. I'm okay using these responsibly a little bit. I don't have a problem with bonds. Bonds can be a good thing, but understand this should not be what you rely on. If you need to withdraw money every year, then you're going to have to ladder these bonds. They don't have liquidity. You should plan on holding them till maturity unless interest rates plummet and you want to take advantage of the profitability of the lowering interest rates. But again, that's more on the speculative side. If you're looking for this to be the safe, stable part of your portfolio, buying a bond and holding it to maturity, you need to calculate the yield to maturity. Watch out for the call options. Believe it or not, bonds can call themselves due because they don't want to pay you interest anymore. And when interest rates drop, guess what they're going to do? If they're paying you 6% right now and interest rates drop to 3% and they still got great credit, they're going to refinance out of you. They don't want to pay you 6% when they can go get a new bond issue and pay 3%. So if you're going to buy individual bonds, you should certainly know when their call dates are. And if you have call dates coming up in the future, you should be calculating your yield to call, not your yield to maturity. Because if interest rates drop, I assure you, they will refinance out of your interest rate they have to pay you. So again, not the full, safe, stable way we used to use bonds. I'm okay laddering them in years that you know you're going to need money. Make sure you have some maturing, just like we used to ladder CDs. You're going to have to do that with these individual bonds. Then we look at things like money market funds. Look, they're fantastic right now. They're wonderful. We haven't seen 5+% interest rates at banks forever, right? That reminds us of the days when checking accounts used to pay interest. Believe it or not, some of us didn't even know that. But the reality is what happens when interest rates drop and you're left with a bank account that's paying nothing and no other good, safe investment options? Take this opportunity to look at your portfolio, stuff that you need to spend soon. If you're just need a temporary holding place because you're going to spend the money, maybe buy a car, maybe a down payment for a house, whatever. That's what money markets are fund. It's not an investing strategy. Money markets are for temporary holding for spending that you know that's going to happen soon. CDs, honestly, you got to look at the same thing on CDs. CDs are just ridiculous. I got to be honest, I don't understand why anybody uses CDs, especially right now when you can make the same amount of interest in a money market fund having access to the whole thing. And then somebody says, well, at least I get to lock in the interest rate if interest rates drop. And I look at them and say, for what, 18 months at most? Well, how does that really help you in the big scheme of things? We got to think bigger than that. No, don't be this generation that's just, right here, right now, that's all I care about. I want to pay the least amount of taxes today. Forget tomorrow. Don't worry about tomorrow. No, we got to think bigger. We need to look at our portfolio and think much bigger than that. CDs, they're not very consumer friendly. They don't give you access to money. Some of them are coming up and getting a little more creative because they know money market funds give you 100% access. So, they get a little more creative to try to compete in this world, but they just can't compete. It's a short-term holding place. If interest rates drop, then what are you going to do? It's the same problem as money market funds. They feel good right here and right now, but in the grand scheme of things, they're not really a good strategy. Doesn't make sense, right? So Then we get into some of the alternatives that are out there. And many of you have discovered these over the last few years, and it's showing up in the numbers by record numbers. Nonstop, we're hitting new records in multi-year guarantee annuities out there. Not me, no. In the United States, trillions of dollars are moving to these things. They are literally just CDs from insurance companies. We can't be afraid of the word annuity. It's just something wrong with what, the blinders people put on just because they heard bad things, or somebody got sold something at a dinner seminar that they shouldn't have been sold. Look, I can show you bad examples. I know advisors that were telling people to buy Enron. Look, I mean, we got to understand that all of these tools that are out there for a reason. And there's a reason there's trillions of dollars in these annuities. First of all, the multi-year guarantee annuities, if you're considering CDs or individual bonds, you have to consider these. They are a fixed interest rate for a fixed period of time with no fees and no risk. Why on earth would we think that these are anything other than CDs from insurance companies? Because that's all they are. These insurance companies specialize in 5, 7, and 10 years. So they're going to allow you to lock in a much higher interest rate for a much longer time, which is what you want to do. Go back to that chart of interest rates. If you could zoom back to 1980, what's the first thing you're going to buy in your portfolio? The longest fixed interest rate you could find. Go to the Treasury and get a 30-year at 15%. That would have been the smartest investment you could have ever bought back in 1981, all right? That's the reality of our situation right now. It's going to be economically very difficult for us to have significantly higher interest rates, but I think most people think we're going to have lower interest rates at some point in the future, or flounder sideways, and that's fine too. But the reality is you can lock in 6% right now. From 5, 7, or 10 years, there are interest rates in these available at 6%. And they give you access to your money, and that's why it's functionally better than a CD. They give you access to 10%. They compound the interest daily. These are much more consumer friendly and much easier to invest in than you think they are. There's no hidden fees. They do pay commissions. They do. Most of these pay 1% to 2% commissions based on your age. The older you are, the less the commission is. This is not world-changing commissions, and they don't come from your money, okay? Nobody does a dinner seminar selling a fixed annuity. They can't afford to. But these are very useful, safe investments for portfolios, and I would put those side by side to any bond or bond fund out there. I would put them side by side to any CD out there. And you will look at those, and any rational person would say, oh yeah, these are way better. Any rational person would say that. And then there's the fixed indexed annuities, just a variation of a fixed annuity, a multi-year guarantee annuity. They're going to define how they're going to pay you interest, and they're going to give you options so you can change how you earn interest. They will give you a fixed interest rate option, and they will give you stock index tied options. Your money is not invested in the stock market. It still has zero risk. And historically, these have been very good, stable, safe investments. And we haven't seen better ones than what we're seeing today, because the insurance companies want lots of new money in there so they can do the corporate lending, buy bonds. They're trying to buy tons of bonds to refill their portfolio. They're being more active than most of these bond mutual funds out there, because they want to regenerate their portfolio with fresh new money to get into these much higher interest rates. And they get higher interest rates than we get. We can't buy the bonds they buy because they can buy big blocks of them at a time. So they are in the business of getting your money in, investing it, and hoping to pay you less than they make. And these indexing products have become so sophisticated in the way that they're paying interest. And now the one flaw they had was they could change interest rates year to year. Now a lot of these are saying, nope, I'm not going to be able to change the interest rate. So even if interest rates plummet, they can't change what they're offering you. So these end up being great, safe investments, and they're going to give you a much better ability to keep up with inflation. Okay. Compared to sitting everything in a fixed interest rate, this is good to add in to help your portfolio be a little more dynamic, your safe portfolio to be a little more dynamic. You're going to earn more interest when things are going well in the stock market, and you're not going to lose anything when things are falling apart in the stock market. So this gives you better flexibility, and it's a good diversification for a safe portfolio. Have some of the fixed interest rates, maybe have a few individual bonds, short-term money, keeping the money markets and CDs, and then add some fixed indexed annuities. Those are all good options. But my point to this is you can't keep doing the same thing and believing that your bonds and your bond funds in your portfolio are the only safe investment you're going to need going forward. You should have changed your portfolio a long time ago. If your advisor didn't, shame on them. If they still say don't, they're useless. I'm sorry. It's ridiculous that we're still in this world where I see people come in and all they have is stock mutual funds and bond mutual funds. That is a ridiculous world that only worked, let's say 40 years ago to about 20 years ago. That's about it. The bond funds have done nothing for 20 years. It's ridiculous. We shouldn't be in bonds when interest rates go to zero. It's always been that way. It's just we kind of forgot. At least some of us did. So please take action. Do something about this. Share this with friends. Subscribe. Give me the comments below. I'm sure that I said things that were inflammatory that maybe make some people upset. There's so many misconceptions of fixed or fixed indexed annuities. Some people still believe in bonds, and I do too. There are ways to use bonds. I don't have a problem with that. But that being your only source of a stabilizer in your portfolio is ridiculous. Now, also, just as a note, not everybody needs safe investments. If you have no need for your money and you're trying to grow it for the next generation or somebody else, and you have no need for it yourself, you don't need bonds. You don't need any of these safe investments. You can have 100% in the market. Everybody's different. Treat your portfolio for your needs, not anybody else's needs. This is a discussion that is rational to some people, but not right for other people, okay? So bonds, if you have them in your portfolio and you need safe, stable investments, either for your own sanity or because rationally you need them for withdrawal. The only thing you should be focused on in retirement is making sure you're never pulling from losses. That's what your portfolio should be designed to do. It's math. You can't pull from losses. You need a stabilizer in there. So shoot us an email, comment below. Give me a call. I'm happy to help out on anything. Share this with friends. Like the video if I made sense. Tell me I made sense. All right, everybody. We'll see you next week.